Investing can be scary business. At any given time, there are all kinds of things to be worried about. Today, many people are worried about interest rates and the fact that they may rise and the impact rising rates will have on stocks and bonds. The U.S. dollar is very strong compared to other currencies, and folks are concerned about the impact that is having on profits, particularly for U.S. companies and international trade. And of course, there are any number of international events ongoing 24/7 that can impact the financial markets. How should we deal with these events as it relates to our investment plan? My name is Rob Berger. I'm the founder of DoughRoller.net and the host of this podcast. And today we're going to talk about 8 ways to avoid emotional investing.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey everybody, hope you're having a great day. Hey, 2 quick housekeeping items before we get to the main topic for today, which is a response to an email that a listener sent in, but 2 quick housekeeping items. First, as I mentioned in the last podcast, you can now record a message to me with a question or a topic you'd like me to discuss, or for that matter, just a success that you've achieved. Maybe you've gotten out of debt, or you've maxed out your 401k, or maybe you've started investing for the first time and you just want to share that with everybody. I would love to get your voicemails and play them on the air. You can leave the voicemail. Just go to DoughRoller.net/voicemail. That will redirect you to the page where you can leave the voicemail. It's set up so that you can record the message and then listen to it before you send it to me. If you've messed up, you don't like what you said, you can delete it, re-record. When you like what you've got, you can then send it to me. As I mentioned in the last podcast, for those that send in a voicemail message, I will move you to the top of the head of the class, the front of the line. I've already gotten a couple of messages already, and I'm working on responses to those questions, and we'll be publishing podcasts on those in the next couple of days. So that's the first housekeeping item. Would love to hear your messages. Again, DoughRoller.net/voicemail, all one word. The second housekeeping item, I have gotten, believe it or not, this may shock most of you, but I have gotten a number of email over the last 6 months from people asking how they can financially support the show. And I was humbled when I got the first one, and I thought, well, this is just, some oddity. This is just some person being nice. I kept getting them. And I've given a lot of thought to that. I thought, should I just bring back advertisers? Should I set up a way to allow you guys to support the show if that's what you want to do? Is there one approach better than the other? And I've decided to go ahead and set up a page where, if you want, you can support the show. And it's easy to get to it. It's just DoughRoller.net/support. It's via PayPal. And you can support on a monthly basis if you'd like. Obviously, no pressure whatsoever. If you'd like to support the show, that's great. If you don't want to or you can't, that's great too. Totally understand it, but you can do that at DoughRoller.net/support. And the thinking behind it, really for me, I decided to go this way over advertising for a couple of reasons. First of all, I try to be as objective and unbiased as I can, but I don't think anyone can be 100% objective or unbiased. And when I have advertisers, I've had advertisers in the past, but I've always picked advertisers who have products or services like Betterment and Personal Capital that I believe in. But can I say that I would be 100% unbiased if they or someone else came back as an advertiser? Well, probably not. I like to think I'd be for the most part, but I guess no one's perfect. And so there could be some bias there. And so that was one reason. The other reason was just time. It takes a lot of time to find advertisers, to work with advertisers, to bill them. And that's time I could be, putting into this show. And so I decided, and the third reason actually is with support from you all, it really tells me how I'm doing. It tells me if you guys are finding this podcast useful and helpful. Again, I understand that not everyone can or will support the show. That's fine. But I thought it would be a good way to judge, how I'm doing, and obviously help support the cost of the show and the time involved in putting it together. So again, DoughRoller.net/support. So those are the 2 housekeeping items. And now I want to get right into the topic for today. And it comes from a listener named Joe. He emailed me back in February, and he said, short email, here's what he said. He said, big fan of your newsletter and economic advice. I'm having a heck of a time adjusting to the new economic normal for the 2015 economy. My wife and I have been successfully invested in blue chips, S&P 500, and balanced equities for the past several years. Should I be concerned that I'm missing the boat this new year? I feel anxious that I need to make some changes, but not sure where to start. Any advice would be appreciated. Thanks. Now, when I got that email, I thought, well, this is a tough one to respond to. It's kind of a high-level, very sort of generic email. And I emailed Joe back. We didn't have an email exchange where I could tell you what his specific concerns were here in 2015. But I do know exactly how he feels. I mean, at any given time, I have all kinds of concerns about the economy and my investments. I'm just, I think it's just my personality. Maybe it's from experiences with money growing up, but I'm just convinced it's all going to just blow up. That's sort of the feeling, the emotion of it. I try to let my brain take over every now and again, and walk me back in from the ledge. But I think at any given time, we have concerns. Sometimes the concerns are overwhelming, like in 2008 and 2009, when we thought maybe the entire financial system might crater. But even now, when, the U.S. economy is doing okay, it's improving, not great, but it's doing okay. Unemployment's come down, still not great. A lot of people aren't participating anymore, so the unemployment rate looks probably looks a little rosier than it really is. But still, things are going okay. But still, I have concerns. Long term, it's interest rates. They're at historic lows. They will go up. I don't know when or by how much or how quickly. But we know they're eventually going to go up. And for savers, that can be a good thing, right? You're going to get higher interest rates on, say, a savings account or certificate of deposit. But as we know, as interest rates go up, the value of existing bonds go down, right? Hope that makes sense to you, but think of it this way. I think I've talked about this in the past. If you have a bond, say a 10-year bond, and it pays 2%, and tomorrow the interest rate jumps to 3%, well, you can hold the bond and still earn your 2%, right? You'll get your 2% from the government, and you can hold it for 10 years. But you're missing out, right? If you had waited a day and invested the next day, you could have gotten the same bond for 3%. Now, this is kind of a silly example. Interest rates like that don't jump 1% in one day, but you get the idea. You could have, you could have had 3% for 10 years instead of 2%. Now, so you're losing that opportunity cost. Another way to think of it is if you decided to sell the bond, why would someone buy it, right? I mean, if you tried to sell it to me, I'd say, look, you're great. I like your 2% bond, but I can go get my own brand new one for 3%. Well, in order to convince me to buy your bond, you would have to lower the price you were willing to accept to a point where your 2% interest plus the discount you were going to give me equals the 3% I could get today on a new bond. Hope that makes sense. The reverse is true, by the way. If you have a bond at 3% and the rate goes down by 2% or down to 2%, the value of your bond goes up, right? You can now demand a premium. You can say, hey, look at my bond. It's paying 3%. And you can only get 2% today. Right? Well, anyway, so as interest rates go up, value of existing bonds go down, and the value of assets go down, stocks or any other asset. I mean, there are at any given time all kinds of factors that affect the value of any asset. But all other things being equal, as interest rates go up, the value of, say, stocks go down. Of course, things are never equal, but interest rates do affect assets in that way. So yeah, interest rates, that's a concern. I mean, I don't lie awake at night worrying about it in a cold sweat or anything, but when I started to think about the economic outlook, interest rates concern me, and they could have a negative effect on both stocks and bonds. So it's like, well, where do you run and hide from rising interest rates? I mean, there's not a whole lot of places to go. The strong dollar, it doesn't concern me as much, except that I do know that it affects profits of U.S. companies, those companies that sell goods and services overseas and collect revenues in those foreign currencies with a strong dollar, when they convert them back into U.S. dollars, they're not worth as much. And that's had a huge impact on profits this quarter. As I record this podcast, Apple will release its earnings at the end of the market close today. Now, I'll publish this podcast a day or two later. But many are saying, and in fact, Apple has announced that the strong dollar will hurt their reported revenues. We don't know by how much yet. It hurt IBM, another company that I invest in, by more than $1 billion. $1 billion, that's, a billion here, a billion there. Pretty soon you're talking about a lot of money. So, the strong dollar is a concern. All of the nasty things going on in our world, you worry about those for a lot of different reasons. But certainly they have an impact on our finances as well. And so at any given time, even relatively calm economic times, there are things to worry about. And the question is, what do we do with that? Should we make changes in the way we invest? Should we change? How would we even go about doing that? Now, Joe's question is interesting because it sounds to me, if I read his email correctly, he does invest in individual stocks, I believe, as well as funds. I mean, he mentioned blue chips, so I'm guessing he invests in individual stocks, and he invests in, mutual funds, maybe a S&P 500, so maybe an index fund. He mentioned balanced equities for the past several years. So, how do you go about thinking through these issues? My general approach, and by the way, feel free to email me and disagree, dr@DoughRoller.net. Please be kind. Well, you don't have to be kind, but email me. People now have started to call me idiot. I can't tell how many emails I'm not getting. People calling me an idiot. If you want to maybe refine that a little bit, I would like to think of myself as a lucky idiot, but whatever. Okay, so my thought today is, how am I going to approach this? I generally don't change my investment plan. In fact, I usually fight the urge to make a change. I fight the urge to worry about these economic conditions, which are always ongoing and changing, and there are always risks and scary things going on somewhere in the economy. I, by and large, ignore it, or try to do the best I can to ignore it when it comes to my actual investing decisions. Now, that is particularly true when it comes to sort of the buy and hold, index fund, asset allocation, diversified portfolio. And I want to walk through 8 ways that I try to do that, or 8 things that help me. Sometimes I'm better at it than others, but 8 things that help me do that. Now, before I get to that, I will say this. It's a little different with individual stocks. It's not a lot different, I don't think, but it is a little different in the following sense. When I'm looking for stocks to buy, I am looking for stocks that are undervalued, in my view, for reasons that I don't think are permanent, for reasons that aren't fundamental to the company. A perfect example would be, I bought ExxonMobil. I'm not sure that was the best investment, but I think it was a reasonable investment. It was down somewhat because of the falling price of oil. Now, Exxon's a complicated company. The way oil impacts it is not nearly as clear as other types of companies, oddly enough. But it certainly has an impact on it. And I don't know when oil will bounce back up. I have no idea. Maybe it'll be years. But I believe eventually it will. And I think, frankly, with Exxon will do fine even if oil stays where it is for a long time. Another example was I invested in Citibank when the banking crisis we were in the middle of the banking crisis. And my basic bet was that Citibank will survive. That was it. If it survives, I'll make a lot of money. Of course, if it doesn't, I lose it all. But I was reasonably confident at the point I invested in that it would survive. Right now, I don't own Citibank anymore, but I'm looking at another. I'm looking to invest in another bank because I think banks will benefit when interest rates rise. That's a complicated analysis, one that I'll be honest with you, I don't fully understand. I'm still studying, but everything I've read tells me that as interest rates rise, a company like Wells Fargo, which is a bank that is high on my personal list, should benefit as interest rates rise, and they can increase their net interest margin, which is the difference between the interest that they charge on loans versus what they pay out to depositors. Net interest margin is pretty thin now, particularly for Wells Fargo. I think it dipped under 3% in their last earnings announcement, I believe, the lowest in, I think, a decade. But in any event, my point is I do look for value opportunities with individual stocks, and that can, in many cases, come about because of things like interest rates or the strong dollar or things like that. So one of the reasons I invested in Deere & Company, I thought their earnings were down, not because there was anything wrong with Deere & Company, but because of the price of crops were so low, and farmers aren't reinvesting in equipment, and that's affecting Deere & Company, but I don't see that as a permanent problem. So in any event, I want to mention that when it comes to individual stocks, I take a slightly different view, but I'm still very much a buy and hold. When I buy a stock, my hope is I will own it for the next 50 years if God keeps me on this planet that long. I'm really not looking to sort of trade out of a stock quickly. And in fact, I have a lot of gains built up in Pepsi, Ford, Apple, Berkshire Hathaway, all in taxable accounts. That, IBM now. I bought IBM a month or so ago, and I've got significant gains built up in IBM because it's done well. That's another example of a company that I think is undervalued, even though it's going through some struggles. So I mentioned that on individual stocks. I know many of you invest in individual stocks. I do kind of look at that a little differently. But back to sort of the buy and hold, asset allocation, mutual fund, ETF, 401k, IRA kind of investing. I work hard to be aware of what's going on in the economy, be aware of what's going on in business, but not let it move me off of my investment plan, at least for the most part. How do I do that? Well, let me give you I'm going to give you 8 tips, I guess, of what I do anyway. A lot of it's just, a way of thinking about this. And then I'm going to give you some resources, kind of a 9th tip, if you will, but some resources. Some you've probably heard of or are all familiar with, but things that I read that kind of keeps me on the straight and narrow. Okay, so that's what we're going to do. Number 1, I recognize that we'll always be missing out on something. One of Joe's concerns was he's missing out, right? You have to consider the other side of the coin. Some people are afraid of losing. The value of what they have will go down. Others are afraid of not gaining, missing out on that next opportunity. And one of the things I've just come to learn is I don't care how you invest, diversified index funds or stocks or options, I don't care what you invest in. You will always and forever be missing out on something. It's funny, I had a conversation with our son who started investing in a couple of stocks. And, of course, he's in training with the Marines now, so he's, not been adding to it. But he told me the other day how he just was kicking himself. He wished he'd picked, I think it was J.C. Penney, I don't remember, but one of his investments had done really well. And he was kicking himself that he hadn't invested more. And I said, I get that feeling. I have that feeling all the time. I wish I would. When I bought Apple at $56 a share, this was pre-split, but that's the after-split price. It was like $390 some, I think, after it had fallen from $700. Man, I wish I'd have shoveled a lot more money into that. But, I didn't have enough confidence. And my belief at the time was it was undervalued. And I had, I had belief enough to put what I put in there, but not enough to put more, right? So you're always going to be missing out on something. And, it's true even with a diversified portfolio. If you've got 10% in emerging markets and one year they're up 50%, man, you wish you'd have put more in emerging markets. Or next year it'll be REITs, and the year after that it'll be small cap value or whatever. It might even be bonds, believe it or not. Long bonds did very well last year. They clobbered stocks because interest rates went down, and people weren't expecting that. Sometimes you wish you had more in bonds. So at every time, I don't care what year it is, you're always going to be missing out on something, and that tells me that I can't. It's going to be a mistake to try to chase the next big thing, because whatever I think the next big thing is, the next year it's going to be something else. It's kind of like when you're on the freeway and you're at a dead stop, a 4-lane road, freeway, and there's always one lane, and it ain't ever the one you're in that's going faster, right? And of course, all the lane changers, we switch over to get into that fast lane, and you know what happens as soon as you do, that lane comes to a screeching halt, and the one you're in takes off, right? Well, that's investing. That's how investing works. In fact, if you look at all of the asset classes and how they perform from year to year, you can see that 1 year small caps are up, and then the next year it's REITs and small caps are at the bottom, and things move like that. And so, trying to chase the next big thing is, I think, a recipe for poor investment results. So, the first thing is that I try to recognize that no matter what I'm invested in, no matter how good of an investment plan, I'm always going to be missing out on something. Something's going to be outperforming whatever I've got or whatever I've done. That's always going to happen. I shouldn't see that as a sign that I've done something wrong or that my plan is no good. And just to give you an idea, before we move on to number 2, and I will include this in the show notes for this podcast, but it's a chart. It's an excellent chart. And it shows you, as I mentioned, all the asset classes. This one happens to be on BlackRock.com, but I'll put the chart in the show notes, but I'll leave a link to it. But from 1995 to 2014, it shows the returns of different asset classes like large cap value, large cap growth, a dividend portfolio, fixed income, small cap, international. And when you look at it, like I'll give you an example. In 2011, any idea what the best asset class was? Well, of course not. Who would know, right? I wouldn't know, but I'm looking at the chart. So now I know. Fixed income, 7.8%. That was number one. It crushed number two. Number two was large cap growth, 2.6%. Fixed income, 2011 was the best performing asset class. You know what it was in 2010? Second to last. You know what it was in 2012? Second to last. I mean, that's what happens. These asset classes, they can be first one year, last the next. Large cap growth was second in 2011 at 2.6%. It was fifth in 2012, but it earned 15.3%. But why was it fifth? Because other asset classes did better. So these things move up and down all the time. And that's why we have a diversified portfolio. It's why we rebalance. It's why we stick to a plan. So again, I'll leave this chart in the show notes, and you can find the show notes. Before I forget to tell you, DoughRoller.net/podcast174. That'll redirect you to the show notes. I'll have that chart and a link to it. And other companies put out similar charts. It's worth looking at because, you look at it, they color code it, and you see all these colors shifting from year to year because which asset classes did best change from year to year. So it's worth taking a few minutes to look at. Okay. Number two is this. I think this is critical. We need to acknowledge what investing fears we have. We all have fears of some kind when it comes to money. In Joe's case, it might be a fear of missing out. In other folks' case, it might be a fear of losing your money. We all have fears, and I certainly have fears. I think they've lessened over the years. I'm not sure if that's because I've gotten smarter or maybe I've gotten dumber. I'm not sure. But we do have fears. My fears have always been just, bankruptcy, living on the street, the world craters. That's sort of my general fear. But we all have fears, and we ought not try to stuff them and hide from them because it'll only make them grow bigger. We need to acknowledge them, and we don't always necessarily need to make any changes in our investment plans because of them. Also, although sometimes we do, right? When we think about risk as volatility and the ups and downs of our portfolio, some folks can handle more volatility than others, either because of just their personality. That's one reason. Some people are more risk takers than others. But that's not always the case. Sometimes it can simply be where you are in life. If you're a year from retirement, even a risk taker should realize that they need to make some adjustments in their portfolio if it's too volatile, because in a year they're going to have to start spending some of that money. So we want to acknowledge our fears. We want to know what they are. Think about how we might address them. That doesn't mean we go out and change everything. Really, we should be acknowledging our fears when we build out our investment plan, right? We don't want to build our investment plan, start out on an investment approach and journey, and then start thinking about our fears. I mean, if that's what you've done, then fine. I mean, that's better late than never. But in an ideal world, you want to think about what your fears are and your concerns. And I don't even want to, fears is maybe even not even the right word because it's got a negative connotation. Sometimes fear is a good thing, right? Not all fears are bad. But in an ideal world, we'll think about those things as we're preparing our investment plan. And that brings me to number three, your investment plan. It should be in writing. Now, to me, if you go to a professional investment advisor, which I am not, as you know, they might prepare a nice, big, pretty 3-ring bound book for an investment plan. To me, an investment plan can be as simple as writing down your asset allocation. It can be in an Excel spreadsheet. It can be on a piece of paper. This doesn't have to be fancy. How much are you going to put in U.S. stock? Well, first of all, how much are you going to put in stocks versus bonds? You should put that down on a piece of paper or an Excel spreadsheet. For your stocks, how much is it going to be in U.S. versus international? If you're going to allocate between small, mid, and large cap or growth and value, developed international, emerging markets, whatever, write it down. Same with bonds. It's going to be all U.S. government bonds. You're going to have some corporate bonds, junk bonds, municipal bonds. And if you're sort of new to the show and none of these terms make any sense to you, no worries. I ought to probably do a show just on terminology. I'm going to write that down. That's a pretty good idea. Um, in any event, you need your investment plan in writing. Now, I mentioned, and I'm still working on it, but I am going to do a show based on a spreadsheet that a listener named Dan sent over to me that will basically give you a free spreadsheet that you can use to not only come up with your investment plan, but then to track it, your performance on all your investments and your rebalancing. And most of it, 99% of it, is automated. It gets updated automatically if you're connected to the internet with values and values of your investments. Really, really cool. I am working on that. Hopefully have that to you in about a week. But in any event, you need an investment plan, and it needs to be written down. Again, to me, it's just asset allocation. Now, if asset allocation is new to you, I would recommend going to DoughRoller.net/podcast25. That's when I talk about asset allocation. Also, in the resources I'll mention at the end of this show are some great books and websites that can help you as well. Investment plan needs to be in writing. Number 4, your rebalancing plan needs to be in writing. When are you going to rebalance? How far out of whack do your actual investments have to be from your plan before you rebalance? Or maybe you just decide, I'm going to take an easier approach. I'm going to rebalance once or twice a year. Here's why it's so important. If you don't have a rebalancing plan, I can tell you what's going to happen. Stocks are going to just take off, and you're going to think, well, I don't want to rebalance in bonds. Who wants to go into bonds? Look how good stocks are doing. I'll ride it for a little bit. I'm going to ride the market for a little bit. And then bad things can happen. Of course, you say, well, good things could happen too. Yes, except that now it's not based on your plan. It's just based on dumb luck. And usually when I talk to people that do this, they never get the timing of the market right, or they do once and then they think they're geniuses, and then they get smacked around the next time. So have your rebalancing plan in writing. Again, it can be very simple. It's rebalance once a year, twice a year. You don't have to do it based on a percentage of deviation from your plan. Although in the spreadsheet I'm going to give you, that's how it works. So it's a little more sophisticated. It's up to you how you want to do it. But you want to have that plan, that rebalancing plan in writing. Okay, number 5, you really need to be a stock market historian. It really helps to know and to see cycles through the stock market, to know that, more recently, probably most of us are familiar, we had the bad market in 08, 09, terrible financial system issues and terrible employment, housing crash. We survived, right? The tech bubble 15 years ago, a terrible stock market crash. We survived. 1987, imagine, look at your portfolio and subtract 20%. Imagine that at the end of today, your portfolio is 20% less than it is now. Welcome to 1987. Scary time. We survived, right? You go all the way back to 1929 if we want, and we survived. But that's not the only kind of stock market history we should be focused on. Sometimes the market just goes sideways for a decade, like it did roughly 2000 to 2010. Sometimes it just goes sideways, or sometimes, think about the early 70s. If you're old enough to remember that long ago, I can, when interest rates were double digits, inflation was double digits. You get a mortgage for, 14%, you thought you got a good deal. I can remember getting that kind of return on certificates of deposit. I don't know if we'll ever go back to that. Who knows? We might. Of course, we survived it, right? But the point is that sometimes we kind of get into this mode where what's going on right now is what's going to happen indefinitely. We get very comfortable, and we ought not to. And that's true whether it's good times or it's bad times. If it's good times, we think it's never going to end and it's all fun and games. And when it's bad times, we think it's never going to get better. This is it. Let's get out of stocks because they're never going to, turn around. And let's put all our money in Bitcoin or, certificates of deposit, whatever. So I think understanding the history of investment in business and the stock market can help us see the present in a more realistic and long-term way. Number 6, I think that favoring index funds, we talk a lot about index funds versus actively managed funds and the advantages of them. They're much less expensive, at least most of them. If you're in a taxable account, they're by and large much more tax efficient than an actively managed fund. And over the long term, particularly in U.S. stocks, they outperform most actively managed funds. But here's the other thing. I think index funds can help us from emotional investing. If you're in an actively managed fund and it's severely underperforming the market, particularly for a couple of years in a row, you start to ask all kinds of questions. What's management doing? If they lost their touch, did a new manager come in? Have they changed the way they're evaluating companies? Was their past performance, which seemed good, just luck? It's funny on that score. I had someone email me and they said, Rob, you mentioned your performance on your individual stocks. Given how well you've done over the last few years, why don't you put everything in individual stocks? Well, it's a great question. The main reason is, a couple of reasons. One, I don't have enough confidence in my ability to invest in individual companies. Quite frankly, that's it. I have enough confidence. My confidence equals the amount of money I currently have in individual stocks. But the other thing is, I call myself an idiot or now a lucky idiot, but there's a lot of truth to that. You can't do well in investments for 3 years and pat yourself on the back and declare yourself the next Warren Buffett. If I do well in my stocks for the next 10 or 15 years, then maybe I'll start to think I know what I'm doing. And I'm not kidding about that. So often we attribute cause to something, a cause and effect to something where it could just be random luck. And that's certainly how I view my performance right now in individual stocks. The same can be true though with active managed funds. You think, well, gee, did they just get lucky? What's going on here? With index funds, it's going to just track the market. And we know the markets, have good years and bad years. That's just what happens. And so I think index funds, at least for me, they help me avoid making rash decisions in either really good markets, we can make bad decisions in really good markets too, or in really bad markets. All right, number 7. Keep your debt low. I know this has got seemingly nothing to do with investing, but I've talked about it before. I think the whole holistic approach to personal finance is key. Part of my ability, we talk about individual stocks, part of my ability to take some people would say it's risky. I don't know that I view it as riskier, but to take that extra risk, if you will, in individual stocks is because our debt is low. I don't need that money tomorrow to pay the mortgage. And I think those folks that got a ton of debt, it will affect your decisions when it comes to investing. It will affect, I think, for a lot of people, their tolerance for handling volatility. And so you want to look at your financial situation. You don't want to just look at your 401k in isolation. So there's my 401k over there. It's got nothing to do with my credit card over here. It does. How you treat your 401k will be in part a result of the rest of your finances and how comfortable you are with your cash flow, your cash management. And if you're up to your eyeballs in debt, it is going to affect your investing decisions. Now, I know you can't snap your fingers and be out of debt overnight, but as part of your long-term plan, you want to be focused on all of these things. Keeping your debt low will absolutely impact how you invest. It certainly has impacted how I invest. Okay, number 8. And this really sort of dovetails back into Joe's question. And this is what I try to do. When I make changes to an investment plan, there are times when you should make changes to your investment plan. But I try to make them based on my personal circumstances, not what I perceive is going on in the market or the economy. Let me tell you what I mean. Take a 529 plan or other investments for your child's education. I'm going to be making changes to the asset allocation. And when I had a 529 plan, my kids are older now, but I did make changes as they neared graduating from high school and needing that money. I made changes to how I invested. It wasn't because of the economy. It wasn't because of a fear of my concerns about interest rates or a strong dollar or anything else. It was changes in my circumstances, or in this case, my children's getting older, right? I knew that I needed the money sooner, so I made changes to my asset allocation. We do the same thing as we near retirement, right? As we get nearer retirement and needing the money, we may make changes. They may be small from year to year, although over time they certainly add up. But I'm making changes based on my personal circumstances, not my concerns about the economy or anything else. And part of the reason for that, well, I think the reasons to make those changes are obvious as you get nearer to needing the money. But the more difficult thing is, why am I ignoring the economy? And here's why. I am no good at predicting the economy. And I don't think most of the forecasters and prognosticators are either. I mean, keep in mind that there are literally hundreds of thousands of people in the news, in the media, in the finance industry, constantly putting out predictions about interest rates, about GDP, growth, all of these things, unemployment, constantly. And then when a reporter needs someone to talk about these issues, they find someone who happened to get it right. And they bring them on. You always hear about them. This is so-and-so. They predicted the housing crash in 2008. Yeah, okay. They were probably predicting it 3 years earlier as well. People aren't good at forecasting this. We get it wrong all the time. And so if I'm going to invest based on my predictions of these things, I'm going to end up with poor results. And here's the thing. It's not enough, if you predict, it's not enough to get it right once in a while. You got to get it right pretty much every single time. You get it really wrong once, and you can erase all of the benefits of getting your predictions right 10 years previous in one bad prediction. So I just don't think people are good at predicting. And I certainly know that I'm not. And so that kind of gets back to Joe's question. And I certainly, as I said at the beginning, I absolutely understand his concerns. I have them too. But have I made any changes to my investment plan in 2015? The answer is no. My asset allocation is the same. Now, I have made what I consider minor changes. One that I made, and this may prove to be a mistake, by the way, I moved my REITs I had them half U.S., half international. I moved them all to international. Still a Vanguard fund, low-cost index fund. I moved them to international because U.S. REITs are so overvalued. So that's not a question of interest rates or the economy. It's just a question of valuation. Now, that being said, the Vanguard U.S. REIT fund has performed just as well as the international fund. In fact, about 10 basis points better, I think, this year from the last time I checked. So, that could prove, I don't think it'll prove to be a mistake per se, but it may or may not help my bottom line. But that's it. I mean, my asset allocation is the same. I haven't changed anything, even though I share many of the concerns that Joe has. And that, again, I have concerns at any point in time. So I, by and large, ignore them. And walking through those eight reasons, that's why or how I ignore them. I think if I try to follow them, I'll end up with suboptimal results. Now, you may disagree. Would love to hear from you if you do. DoughRoller.net. Now, before I close out the show, a couple of resources, because you can almost consider this tip number 9, and it's this. Read really smart investors. Learn from the best. That's what I try to do. And so let me give you 5 resources. I've mentioned them before, but I think they're great. One is Buffett's annual letter to Berkshire Hathaway shareholders. Just look up Berkshire Hathaway. You'll go to their main website, which is really awful looking, which is funny because he spends no money on his website, and I love that fact. But you can get all his letters for free. They really are gems. I mean, they're a joy to read. Even if you don't invest in Berkshire, even if you don't invest in individual stocks, it can teach you the right way to think about investing from the best. So Warren Buffett's letters, that's the first thing. All About Asset Allocation by my good friend Rick Ferry. I've had him on the show before. It's a great book on investing through diversified low-cost funds. All about asset allocation. You can get it at Amazon. You can probably get it at your local library. 4 Pillars of Investing by William Bernstein. It's another one that I like a lot, an older one, but I've read it. It's been many years now. I should go back and reread it. Great book. John Bogle, founder of Vanguard. He's written the Little Book of Common Sense Investing. That's a really quick read, a newer book, but a great book. So that's a good one to follow. And then the Bogleheads Forum. So the Bogleheads are a forum, a group of investors named after the founder of Vanguard, John Bogle. I don't know how they came up with the word Boglehead, but they did. Just Google Bogleheads Forums. It's a great active forum. People put in there their actual asset allocation, what they're investing in, and then people comment on it. And they're by and large kind, I think. I get on there every now and again, but I'm not an active participant, just don't have the time, but it's a great forum. So there you go. That's how I sort of deal with all of the things that go on in the economy and in the world. And yeah, I try my best to follow them, but not have them influence my investment plan, at least not very significantly. So there you go. Have any questions? Shoot me an email, DoughRoller.net. Remember, if you want to get your question to the front of the line, leave me a voicemail. DoughRoller.net/voicemail. I've already got a couple, and I love it, and I'm working on those. Well, those will be, I'll create shows from those here shortly. Hey, hope you have a great day, and remember, until next time, the best thing money can buy is financial freedom.